Have you ever wondered how the complex world of stock markets operates? This vast, intricate network that fuels economies and shapes financial futures might seem intimidating, but once you break it down, it's a fascinating process worth understanding. Picture this. A private company decides to go public, issuing what's known as an initial public offering, or IPO. During this process, the company offers a specific number of shares to the public at a set price. The goal? To raise capital from investors, and in return, these investors gain ownership in the company. But what happens next? Well, these shares then enter the secondary market. This is where stock exchanges like the New York Stock Exchange or the Nasdaq come into play. Here, investors trade these shares amongst themselves. The price of a stock isn't static. It fluctuates based on the dynamics of supply and demand, influenced by numerous factors from company performance, industry trends, to economic conditions and even geopolitical events. Now, you might be wondering, how does one actually buy or sell these stocks? Enter brokers and exchanges. Investors usually conduct their trades through brokerage firms, which act as the go-between, connecting the investors and the stock exchange. These brokers execute buy and sell orders on behalf of their clients, charging a fee or commission for their services. Stock markets aren't a free-for-all. They are regulated by government agencies and financial regulatory bodies. These entities establish rules and regulations to ensure fair trading practices, protect investors, and maintain the integrity of the financial markets. But how do we measure the performance of a stock market? This is where stock market indices come in. Indices like the S&P 500 or the Dow Jones Industrial Average track the performance of a specific group of stocks, providing a snapshot of the overall market trends and investor sentiment. And finally, how can you, as an investor, participate in the stock market? There are various investment vehicles at your disposal, from individual stocks, exchange-traded funds, ETFs, to mutual funds and other financial instruments. Different investment strategies cater to different risk appetites and financial goals, whether it's value investing, growth investing, or day trading. So, to summarize, stock markets operate through a series of steps, starting with an IPO, followed by secondary market trading on stock exchanges. Brokers facilitate these trades, and prices are determined by supply and demand. Regulatory bodies oversee the markets, and performance is tracked through indices. Lastly, investors can participate through various investment vehicles and strategies. Remember, while the allure of the stock market can be strong, it also carries inherent risks. It's crucial to conduct thorough research and consult financial advisors before making any investment decisions. After all, knowledge is power, especially when it comes to navigating the world of stock markets.